Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to learn about bearish spread strategies. This video will focus on two types of bearish spread strategies, bear call spreads and bear put spreads. Let's first look at bear put spreads. This strategy is known as a vertical spread. It involves buying a put option and simultaneously selling a put option with the same expiration month, but with a lower strike price. This strategy is referred to as a debit spread, as it will always require an upfront cost to establish the strategy. However, the premium collected from the sale of the put option with the lower strike price serves as a way of decreasing the overall cost of purchasing the other put option. The objective of the bear put spread is to benefit from a decrease in the underlying at a lower cost. A bear put spread will react in a similar way as a long put position. However, unlike the long put position, profits are limited and will not increase as the stock falls below the strike price of the short put position. The best case scenario is the stock price falling below the lower strike price at expiration. Under this scenario, the investor would exercise the long put option and presumably be assigned on the short put position. The stock would therefore be sold at the higher long put strike price and simultaneously be bought at the lower short put strike price. The potential profit is consequently the difference between the two strike prices less the net premium paid to establish the strategy. On the other hand, should the underlying price at expiration be above both strike prices, both options would expire worthless and the net premium paid represents the maximum risk of the strategy. When selecting the option contracts to be used in the bear put spread, it is important to remember that this strategy requires the share value of the underlying stock to decrease below the strike price of the put option sold prior to expiration. As such, the expiration date selected should allow sufficient time for the stock to make the anticipated move to the downside. When selecting strike prices, at the money and in the money options are typically considered more conservative. However, the spread will be more expensive to establish than if out of the money options were selected. Conversely, bear put spreads created with out of the money options will cost less to establish and will therefore allow for greater profit potential. Let's now look at an example. Let's consider a stock trading at $72 per share. An investor has a moderately bearish outlook on the stock for the next few months and elects to purchase a 3-month 72 strike put option, which trades at $5.30. The investor may believe that the premium of the $72 strike put option is fairly expensive, and in order to offset some of the costs, decides to sell a 3-month 65 strike put option for $2.75. The 65 strike put option is selected because the investor, although bearish, does not feel the stock will drop below that price. The net cost of the strategy has now been reduced to $2.55. The following graph displays the risk and reward profile of the bear put spread that was established by the investor. The maximum profit potential is calculated by subtracting the debit incurred from establishing the strategy from the difference between the strike prices, which in this example is $445. The maximum loss is limited to the net cost of the strategy, which corresponds to $255. Note that in this example, the stock must be below $69.45 by expiration to break even. This is calculated by subtracting the cost of the trade to the higher strike price. This table reflects the potential profit and loss of the bear put spread using various stock prices at expiration. Notice that the investor will not benefit from a decrease in the underlying below the strike price of the put option sold, which is $65. The potential profit will remain capped at $445. On the other hand, if the underlying increases in value or stays relatively the same by expiration, the investor risks incurring the maximum loss of $255. As a reminder, the maximum loss cannot exceed $255. Now let's take a look at another type of bearish spread, the bear call spread. The bear call spread is also a vertical spread strategy, and as with the bear put spread, it requires the investor to sell a call option and simultaneously purchase another call option at a higher strike price. However, the bear call spread will not create a debit. Instead, the strategy creates a credit in the investor's account due to the relation between the two strike prices selected. As with the bear put spread, the sale of the lower strike call option is meant to partially offset the cost of purchasing the call option with the higher strike price. However, The bear call spread is generally established to generate income as opposed to taking advantage of a directional move. One important similarity between the bearish spread using puts and the one using calls is their risk-reward profile, which is identical to one another. The profit and losses are both limited. In the case of the bear call spread, the profit is capped at the credit collected and the loss is limited to the difference between the two strike prices less the premium collected. If the underlying stays the same or drops below the lower strike call, both options will expire worthless and the investor will get to keep the credit initially collected. Under this scenario, the investor will have achieved the maximum potential profit. On the other hand, if the underlying increases, the investor runs the risk of being assigned on the short call position and forced to deliver the underlying. The investor would then have the ability to exercise the right to buy the underlying at the higher strike price. Under this scenario, the investor would incur the maximum possible loss, which corresponds to the difference between the two strike prices less the net premium received. When selecting the option contracts to use in a bear call spread, it is important to remember that this strategy requires the share value of the underlying stock to remain neutral or decrease below the strike price of the call option sold prior to expiration so that the written call option expires worthless. Since the profitability of the position depends on the options depreciating in value, options with near-term expiration dates are typically used since time depreciation will play in favor of the investor. When selecting strike prices, at the money and in the money options will generate greater income, but the larger premium also reflects a greater chance of being assigned at expiration. Conversely, bear call spreads constructed using out-of-the-money options have a higher probability of expiring worthless and making the position profitable. However, the premium collected is smaller in comparison to at-the-money and in-the-money options. Let's now look at an example. Let's consider the same stock we looked at earlier, which was trading at $72 per share. This time, the investor has a neutral to bearish outlook on the stock and wishes to sell a 1-month 75 strike call option, and by doing so, collects a premium of $3. In order to limit the risk associated with selling the call option, the investor chooses to use a portion of the premium collected to buy a 1-month 80 strike call option, which currently trades at $2. The net credit received from establishing the bear call spread now corresponds to the $3 premium received from the sale of the $75 strike call, less the $2 premium paid to buy the 80 strike call. The following graph displays the risk-reward profile of the bear call spread that was established by the investor. The maximum profit potential corresponds to the net credit received, which is $100. On the other hand, the maximum loss has been identified to be $400, which is obtained by calculating the difference between the strike prices less the credit received. Note that in this example, the stock must be below $76 by expiration for the position to break even. This is calculated by adding the strike price of the sold call option to the credit received. This table reflects the potential profit and loss of the bear call spread using various stock prices at expiration. Notice that regardless of how low the underlying value goes, the maximum profit of the bear call spread is capped at the premium collected. Therefore, as long as the underlying remains below the strike price of the call option sold, both options will expire worthless and the investor will keep the $100 premium initially collected. If the stock is trading above the break-even point on expiration, the investor will experience a loss. However, the loss is limited to the difference between the strike prices less the premium collected, which is $400 in this example. Note that although the stock has unlimited upside potential, losses will not exceed $400 in this example. When deciding which spread strategy is the most appropriate to use, the investor must consider several factors, including their objectives, outlook, and risk tolerance. Since the bear put spread and the bear call spread have identical risk-reward profiles, the main consideration when implementing a bearish spread strategy will be the investor's objectives and outlook. A bear put spread requires the underlying stock to decrease in value before expiration. This suggests that the investor is looking to profit from a long put position and may wish to offset the cost of an expensive option contract by selling a put option, which creates the bear put strategy. This strategy is sensitive to time depreciation as enough time must be given for the underlying to move. Conversely, a bear call spread may be used if an investor believes that the underlying is likely to remain neutral. The investor should have a neutral to bearish outlook, but should not expect to profit from a decrease in the underlying share value, as maximum profit is realized upon options expiring worthless. With that being said, the passage of time will play in the investor's favor. If we look at the potential profit and risk of the examples we used earlier, it demonstrates that typically the risk associated with a bear put spread is less than the risk of a bear call spread. Also, the profit potential of the bear put spread in relation to the risk associated with the position tends to be greater in comparison to the bear call spread.